Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. John, what's going on?
Same old stuff, Eric. Good to hear your voice again. How you feeling? You're a little under the weather, I recall.
Week six of, this stuff, and the vocal cords are a little different. Longtime listeners will notice that I'm a little froggy or something. I don't know what term that is, but I'm getting through it. Yeah, well, it's good to be back with you guys.
Yeah, good to be back with you, sir.
Yeah, absolutely.
Michael, what's going on?
Yeah, it's, again, same old stuff. The year is already off to a frenzied start. So we are, we were just talking before that's already almost through the first month of the year as we're recording this. So it's moving quickly.
And you brought a guest on the show. Yeah, you brought a guest on the show to talk about this, right?
Yes, we have. We have brought Christian Hyldahl from Varium Investment Partners. He's a returning guest. We've had Christian on, I think, at least once, maybe twice on our podcast. How you doing, Christian?
I'm doing well, thank you.
Excellent. Yes. And Christian and his group, Varium, they operate as an outsourced CIO, Chief Investment Officer, for our firm and some other firms out there. And so we figured that given it is the start of the year, we wanted to have Christian on and have him discuss his expertise and his team's expertise in terms of what they are seeing for this upcoming year as it relates to the economy and the markets, and what's news is happening all the time, obviously, but kind of sift through the noise a little bit. So hopefully, Christian, you can enlighten us and our listeners. But why don't you give us kind of your, at a high level, let's get started. Like, what's your market outlook this year?
Well, unfortunately, obviously 2022 was kind of a rough year in pretty much all markets, except for some select commodity markets. And we are really not seeing a lot of great signs for 2023. We're getting a little bit of a dead cat bounce here. Last couple of days, people kind of holding out hope that the Fed is going to somehow miraculously pull a Sully and land the plane on a river without hurting anybody. But we just don't see that as being a high probability outcome. So we are still remaining very cautious. There are some markets that are a lot more attractive than they were even a year ago. Income markets. Equities, we think, are going to be in for another rough year. As we kind of work our way through the calendar here, we do think that the higher interest rates and even higher interest rates to come are going to really put a damper on the economy. We're already seeing that a little bit. I hate to say it's different this time, but it really is kind of different this time in that we don't really have history of where we've had such low unemployment, such high inflation. And we really think that gives the Fed the opportunity to really step on the brakes here, and they probably will overshoot. Unfortunately, we've written about this in the past. Their tools are a rather blunt instrument. We've compared it to trying to kill a fly with a sledgehammer. You might get the fly, but you're going to do a lot of damage. And unfortunately, that's what we're expecting, particularly in the equity markets. The U.S. market is, we think, still fairly overvalued for what we're seeing in the economy to come. There's some better markets overseas, but believe it or not, Europe's still a bit of a basket case, but they're much more reasonably priced, and probably will present some opportunities to make a little bit of money or not lose as much money in the equity markets. But the fixed income markets are really presenting some pretty nice opportunities, particularly in mortgages. And we think there's some opportunity to be very selective in allocating some capital to the fixed income markets. But we still are very, generally very cautious on equity markets, particularly the U.S. market.
Christian, when we've talked to you in the past, and we may have even touched on this in a prior podcast, but sort of the information I'm gleaning from just what you went through is that like you said, that this time seems to be different than in other times. And I'm wondering, from a sort of a portfolio management standpoint, if you see that there are shifts that are occurring. And I say that only because it seems, we in our industry read a lot about passive investing and, lowering the cost of investing, your portfolio, not having a lot of active trading and things of that sort. And of course, I'm sure there's value to that. But are you seeing a shift in that philosophy after this last 12 years of a bull market? Now we're leading into perhaps some uncertain times.
Well, admittedly, I'm biased because I have always believed that active management is superior to a passive approach. I do believe there's some tricks and tools that experienced and intelligent investors can use that can allow an active management strategy to outperform. Unfortunately, the active management community has done a pretty wonderful job of dulling those tools to the point where, I'd probably say 80 to 85% of active managers out there are sort of closet indexers. And that really presents an opportunity to be mediocre. And that's really what we've seen. But I think if you look at the top decile managers and forgetting the absolute performance, if you look at the portfolio construction, which is when we're doing our manager due diligence, is really the first thing we look at. If you own 70 or 80 or 90 stocks in a large cap growth portfolio, you're basically an index. And if you're charging 75 or 100 basis points or even more, you're going to get an inferior return. So we think that having a more concentrated, not necessarily concentrated portfolio, something between 25 and say 40 stocks in each style box, is really the approach that will allow outperformance over a period of time. And then you throw in a couple of value-added strategies like a covered call strategy, which again is not rocket science, but it's a big time consumption, tracking and monitoring that, adjusting prices as the underlying stocks move. That can add another 2 to 3% on a year-over-year basis. And nice. In a market that we think probably doesn't have a significant opportunity to deliver even high single-digit sort of returns, it's an approach that more people should be doing. It's something that really lends itself to active management. You combine that with having the ability to do your fundamental analysis, your technical analysis, your quantitative analysis, and just doing a lot of data analytics, which is what we do here. I'm fortunate to have a really highly skilled team of PhDs and CFAs with lots and lots of experience in managing money to do that with me and for me and for the people we work for. It presents an opportunity to really deliver outperformance. And in this particular time, capital preservation is really first and foremost in our minds. And we were able to deliver a positive return last year. We did that by really staying on the sidelines to almost an uncomfortable level of maintaining cash and just being very prudent with the kind of companies that we invested capital in. Again, focused as interest rates rose last year, being selective in our fixed income allocations and making sure that we stayed very short. We were rolling over a lot of bonds and just being very practical in our use of cash. And unfortunately, a lot of people over the years have viewed cash as a really negative thing to have in a portfolio, but it truly is an asset class that does deserve to be viewed as such. And when you have the ability to hold cash in a market that was really very clearly overpriced and facing significant headwinds like we did last year, it's a good place to hide. And it's difficult in an environment where inflation is deleting the purchasing power of that cash, but it beats losing 30%. And so that's really what we are looking out for now. We continue to be pretty cautious. It's a capital preservation type of market where there's still really good companies out there that you can invest in. But it does take a bit of skill and some really deep research to ferret out the ones that do have the capability of delivering a positive return, and then doing some of those things that again are a bit mundane. The covered call strategy is again certainly not a sexy approach to wealth management, but it is one of those things that is a sort of a building block of delivering positive returns and making the portfolio work harder, making money work harder.
Yeah, Christian, can you walk through that covered call strategy as a concept? And I'm sure some of our listeners would probably benefit from a description of, and as a concept, how that works and how that can, like you said, add some additional performance if done properly in a portfolio.
Sure. So it's a fairly basic strategy. It basically is a contract that someone who holds an underlying stock is basically delivering the option, but not the obligation to sell at a future price if the price doesn't rise above the strike. So there's two aspects of it. There's three, I guess. Owning the underlying stock. So let's just use Microsoft for instance. You own 100 shares of Microsoft, and trading at $200 a share or whatever it's trading at right now. And you basically say the way we do it is we do it month by month. So for February, for instance, the third Friday of February, this option will expire. So let's say Microsoft's trading at 200. We will sell a call, and it's called a covered call because we own the underlying stock, meaning that if it does get called away or we have the obligation to sell it to whoever owns the other side of that call, can call it away from us at a specific price. So let's say that we say for the next 3 weeks, we are comfortable if Microsoft goes to $210 a share, we're comfortable selling it there. 5% return in a month is a pretty decent number. But for us to sell that potential of having it called away from us, we require a premium. And so we will sell that obligation for, let's say, $2. So 1% of the value of the stock requires us to potentially sell that at a price of $210. Well, that's a 6% return in a month. We're comfortable doing that. We can always buy the stock back if we still think Microsoft has a bright future ahead of it. But it basically just means that we're going to collect $2, which is $200 because we have 100 shares. And so it's basically a strategy to create a synthetic dividend in companies that we believe still have the potential to rise. And so if the company currently pays a dividend, we still collect the dividend, but we are in a way creating a synthetic dividend and creating a cash flow out of that stock by holding it and selling it at a higher price, potentially.
Okay.
Yeah, and that's again, that strategy, like you said, with the premium and that income that you can generate does help. And again, this is sort of what I've learned from my conversations with you, Christian, is this is some of the benefits that having that active management can afford you as the investor, because I've learned about how you're sort of nibbling around the edges, as I think you've used the term before, and that can help over long periods of time, particularly in a market like you're thinking we may be in, where you need that. Every little bit helps.
The beauty of it is that's just for 1 month. So we collect $2 for February, and then we'll do it again in March, and we'll do it again in April, and we'll do it again for the following months. So if we're collecting $2 every month, that's $24 on a $200 stock. You've got a 10-12% return just in your covered call strategy. Now, we don't always sell them. We do offer up the entire portfolio, where we will sell a call at obviously a higher price, and then we'll collect whatever premium we can. And a lot of it is based on volatility of the underlying stock, and we have the data and the systems that we can tell the volatile stocks from the not so volatile stocks, and a volatile stock will get a higher premium. And again, if we can generate probably a 3 to 4% return just on the covered call strategy in the entire portfolio, that is particularly in again a low return environment, it's a very attractive strategy, a low risk strategy. I always say you really don't lose. The only potential quote unquote loss you have is the opportunity to have made more money hanging on to the stock if it does, for some reason, go up more than the 10% that we offered out as the strike price.
Gotcha. Right. Let's get back to how your average investor thinks. Right now, we just came off a 12-year bull market. They have a portfolio with their advisor. It's dropped 30%, 20%. It doesn't matter what number it is. It's down. And their instinct is, I'm afraid this is going to get worse. I think I should sell, and I'm not sure what to do. And, how do I look at this? I'm a little nervous about that preservation, my principle. What advice do you give this investor? We don't get a lot of that here because our investors, know the answer to that. But I want maybe you explain how you look at it as a professional that actually manages the portfolio.
Well, history has shown that over time, the market does go up. The economy expands, companies do well, their price goes up as their earnings go up. And, the market itself will fluctuate between people willing to pay when you're buying a stock, you're essentially buying the future. So that's where the multiple comes in, the multiple of earnings or the multiple of cash flow. And there are times when people will be much more willing to pay a higher multiple because they view the economy as being stronger or faster growing. Or in the case of the last 12 years, we had near zero interest rates, which, the market is a discounting mechanism. And so when you're projecting earnings out into the future, you have to use some sort of discount rate to bring those back to a current value. That's the fundamental analysis that we do. And when your interest rate is darn near zero, if not zero, you're discounting those future earnings at a much, much lower rate, meaning that there's going to be a higher price that people will be willing to pay. So the market will fluctuate between, let's say, 24, 25 times earnings, which is very high historically, to a more conservative, 14% when times aren't viewed as being very positive in the future. So long-term strategy is we always recommend that people stay invested. That doesn't necessarily mean fully invested. And so what we say is it's a little bit difficult to just generically say what they should do, but we say, let's have a look at your portfolio. Let's see how your capital is allocated. And we'll usually make some recommendations about, this is a very growth-oriented portfolio. We don't think growth is going to be the place to be in the next 12 to 18 months. Maybe we should reallocate that capital into something different that we think has a higher potential for return. So, we'll dig into portfolios and give a fair and honest assessment of what we think the market will do. We're not always correct, but we, over time, have proven to be more right than wrong. And occasionally we'll miss some stuff. But for the most part, being invested, not necessarily fully invested, again, using cash as an asset class, has proven to be a good strategy. But for the most part, we say the economy will grow over time, and that means that stocks will appreciate over time. And as long as your time horizon isn't, 2 years, then you can kind of ride out the waves. But again, it really comes down to how you structure the portfolio. Again, we are big believers in active management done properly. And we think that over time presents opportunities to significantly outperform the market. And the active strategies, again, a lot of managers have done a really great job of making themselves obsolete. And passive has worked remarkably well over the last 12 years when the market just sort of gently rose up and to the right, and it wasn't real complicated to invest client assets and deliver a positive return, simply because the tailwinds were pushing markets higher. We don't think we're in that environment anymore. We think it's going to be a much more selective market, a market that really does benefit active management. And so that's what we tell clients is let's have a look at where you're allocated. Don't fall in love with your investments. They're not your children. They're just a tool. So be willing to change your mind about where the economy and the market's going, and particularly where certain companies are going, and be willing to, some folks are like, I love stocks. I would just want to invest in stocks. And, a lot of the conversations we've been having lately is, well, stocks aren't the best place to be right now. It's actually kind of boring fixed income stuff that we really like right now. And you have to resign yourself to the fact that you're probably not going to get double digits returns. And certainly the risk that you're taking to try to achieve that is probably not going to be justified by the return that you get.
Hey, Chris, the reason why I brought that up is we had an individual referred to us a while back. It was 2020. It was early 2020. It was being managed by a trust company, and the market cranked downward, as you know, like 30% within 2 days. Remember that market was crazy. Well, he told his advisor, bail me out. The world's coming to an end. He sold out of that account. It caused a huge capital gain tax because it was all pretty much a gain portfolio. It was a non-qualified account, non-IRA. And I had a conversation with him, and he said, yeah, I bailed out of the market. I was very uncomfortable. I don't like what I was seeing. I'd rather be in cash, whatever. And I said, I appreciate what you did, but your emotions kind of got in the way here because we think the market's going to turn around pretty quickly. And sure enough, it did. So what he took all those losses, went to cash, big tax problem, and the market excelled over the next 7 months. It actually had gains by year end. So the bottom of the story is he panicked emotionally. And what you did was a very technical, very orchestrated, stay with the markets. The markets do X, Y, and Z, be patient, whatever. But a lot of the people, emotions get in the way. Hard to control that, but that's why you're in business and we're in business trying to help clients through those tough times so they don't make those mistakes. But that's the things that we see and hear from our clients. Sometimes their emotions just get in the way. They make a mistake.
Yeah. Money creates a lot of emotion.
Yeah.
And
absolutely.
losing it creates a lot more of a negative emotion than making it does. The fear factor is always greater than the greed factor, at least in most cases. And when you do decide you make a decision like that, you're forcing yourself into two decisions. The first decision is to sell. The next decision is, okay, when do I get back in?
Exactly right.
And that does create, it's a difficult decision because you're reacting emotionally to fear. In most cases, you're not going to make a really great decision when you're reacting out of fear. And there's better strategies than just blowing out a portfolio. So what we would have recommended is, okay, if you're really uncomfortable with it, why don't we buy insurance on your portfolio? It might cost 1.5%, 2% of the value of your portfolio to basically offset any losses with something we'll invest in that will have a gain. We like to use volatility, so we buy an option on volatility. And that volatility rises as stocks decline. And so, paying 40% or 2%, which would you prefer? And then we can take a non-emotional decision to maybe reallocate the portfolio. It's always good to sort of visit your portfolio and make a decision today, not yesterday, last month, last year, about what is a great investment, because the market changes all the time, and the outlook for the market changes all the time. And so being able to come at it fresh today in the moment and make an honest assessment of where you think the economy is going, where you think the industries are going, where the individual stocks are going, that requires a very active approach. And again, that's what we do. Unfortunately, there's a lot of folks out there that are managing client assets that don't necessarily take the same view and just basically have a single strategy that they've had for 20, 30 years of their career, that just buy and hold or buy the dips. And sometimes that's just not a great strategy. It has worked. I mean, it's been sure. I've been in the business, I can't believe it, 31 years now. I mean, if I would have put money into the market in 1992 when I started in the business, I would be up, 10, 15 times my original investment. But I had 30 years to do that. When you're making an emotional decision about the next 2 weeks or 2 months or even 2 years, you can definitely hurt yourself and hurt your strategy.
real quick before we end today's session, if you're going to read the tea leaves, as people listening to the podcast, if you were to look at the stock market in 2023, is it going to be positive or negative in your opinion at the end of the year?
Well, I would say if I was betting, and we don't like to compare investing to betting because it's not, but I would say we're going to be lower.
Okay.
I do think that the Fed is probably going to overstep. The economy is going to be probably a little worse than people are expecting. I would say we're probably not down more than 10%, but certainly 10% down would not surprise me.
Okay. How about the bond market? Where do you see the bond market?
Well, I think the bond market has reached a very nice equilibrium here. And I think there are opportunities in select markets that you can make a low single digit, 5% type of return, being really patient and picking the right areas to invest in, the right companies to invest in. I don't think interest rates are going to rise significantly from here. Maybe a little bit. The Fed probably is going to do something here, I guess, 7-8 days. Well, probably 25 basis points, but maybe a 50 basis point increase. I think there's probably a real heated debate going on between the Fed governors about what is the appropriate level of an increase. But we're going to see smaller rate increases over the coming months, probably stopping in the summertime as they'll digest data. But I don't think that putting money into the fixed income market is a bad idea. In fact, it's our best idea right now, and an area that we're spending an awful lot of time digging around in and trying to find good names and good companies to invest in.
Excellent.
Interesting. Well, Christian, as always, thank you for your expertise. Thank you for being a guest. And I know we will have you on again in the future. But until then, pay attention. I know you will, and continue to do what you guys do. It's great. So thank you so much.
Keeps me up at night. All right, guys, take care.
Thank you, sir.
Christian, this has been fantastic. Again, I just want to echo what the guy said. Thank you so much for being a part of the podcast and bringing such great information. John and Michael, again, bringing on guests that absolutely have a ton of knowledge in the area that you've asked them to speak about, and this was no different. So thank you so much for providing this. And of course, our last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Securities offered through American Portfolio Financial Services, Inc., a member of FINRA SIPC, investment advisory and financial planning services offered through American Portfolio Advisors, Inc., an SCC registered investment advisor. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Copper Beech is an unaffiliated entity of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Any opinion expressed in this forum is not the opinions of American Portfolio Financial Services, Inc., and American Portfolio Advisors, Inc., and have not been reviewed by the firm for completeness or accuracy. American Portfolios and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.